Hi, my name's Paul Durso, and in this short video we're going to go over a few things. Odds are the reason why you're watching this is you have the opportunity to retire early. You've been given a retirement package or offer to leave your company, and you've got some big decisions. So what I'm going to go over with you today is a simplicity plan. I'm going to show you firsthand how quick and easy it is to get some answers of the very big and difficult decisions you have to make. Some of those decisions are, should you take the company annuity or lump sum that you're offered by your company, should you take your pension or annuity versus the lump sum? Which is better, which is worse? What are the different things that you need to worry about or be concerned about each of those decisions? Should you invest in long-term care? What are the biggest concerns you're worried? Do you have enough money to retire and you can take the package and never have to worry about going back to work? These are some big questions, and we're about to show you how to very quickly and easily see some insights that you're dying to know in your own life to see if you can afford to take that package and retire without ever needing to go back to work. So first, let me jump into an overall plan. This is a made-up person, but there's some real statistics, real information in here that can help you understand. And the beauty of what I'm going to show you is I can take you through this personally here in our office in Valentine, or wherever you are. We can build a simplicity plan just for you, put your information in, and see if firsthand if you have the ability to retire and never have to worry about going back to work. So we've got Ozzy and Harriet. You may or may not know who that is. 60 and 60, or 65 is Ozzy, Harriet is 60. They want to retire in 2 years. They want to retire on about $115,000 of retirement income. That means their lifestyle that they want to live on in retirement is about $100,000, a little over that. I can tell you their total assets, they've got about 1.3, almost $1.4 million. With Simplicity, we wanted to organize investments in a very quick and easy way to understand them. And when it comes to risk, when it comes to Wall Street, and comes to investments, sometimes it's not so easy to understand things. So we visualize that with a tree. There's two parts to a tree. There's what we call above ground, the part of the tree that you actually see, and then there's below ground, the roots, that of what you don't see. And we visualize that here. Root investments, below ground investments, are one of three things. Bank-backed investments, these are FDIC government-backed investments. FDIC bank-backed investments. We have government-backed investments. These are backed by the full faith and credit of the United States government. And the third are fully insured. So if it's bank-backed, government-backed, or insured, it's below ground. Everything else is above ground. So if you've got any stock market mutual fund and it's not FDIC insured, government backed, a tip or a treasury, or an insurance product that's backed by the full faith and credit of the insurance company, then it's above ground. And we're going to see here is this person's got about 90% of their assets above ground, 8% of their assets below ground. All that means is they have a lot of volatility in their life. They have a lot of investments that are not protected. And if the market continues to be crazy or is crazy, they're going to feel it because there's going to be lots of volatility. This isn't good or bad. This is just reality. This other part right here we call your principal tax concern. Their principal tax concern is 79%. That means 79% of their 1.3 million is taxed at the principal level. This is a big issue that comes up in a lot of client meetings. They've got over $1 million of IRAs and 401ks that are fully taxable at the principal level that they have to deal with. That means of this $1.3, $1.4 million, it's not all theirs. Over $1 million of it's in joint custody with Uncle Sam. And taxes are a big issue. Nobody likes to pay taxes. You think you don't like to pay taxes now? Wait until you're in retirement. They get even worse. So this is a discussion starter to see if there are things we can do to strategically reduce the amount of tax that you're going to pay in retirement. Anything we can do to plan ahead. That's a big discussion item. Another thing that we want to talk about, this big chart that you see right here, is called your retirement income need. This is one of the most valuable aspects that we talk about. And this entire chart here represents the total amount of income that you want to spend in retirement. For this particular person, that's that $115,000 multiplied over the rest of their life plus inflation and taxation. And from 0 to 100 here, that's what they want to hit. They want to have 100% of their income accounted for. But only 58% is. 58% of their entire retirement income is represented in this 58% by Social Security and some pension income. Because they've got an offer from their employer to retire early. So we added their pension amount in here, and they also get some Social Security. So 58% of their income is accounted for. That means the other 42% have to be generated by their nest egg. All the money that they have invested has to generate 42% of their income every year over the rest of their life. And this is the biggest reason that I've seen firsthand of why people panic. Because they know they're not going to have all of their income in retirement accounted for. And this red part, what they have to generate on an annual basis, panics them. And they're like, the market's undependable, it's volatile. How in the world can I get predictable income in a volatile, unpredictable place? I'm never going to be able to retire. And that's where we can help you, specifically planning for it. One more thing that I want to jump into very, very quickly. When you look down here, this is a visual representation of the rest of your life mapped out from an income perspective. This black line represents the amount of income that you want to live on in a given year. So you're going to see this first part is 115,000. The reason why it's going up is because of inflation. And your 115 won't always be 115. The blue part of this chart represents the income that's coming in from Social Security, rentals, or pension income. So they've got that 58% of their income accounted for, and as you can see, early on it's not that much. There's not that much gap here, but the further they go on in retirement, the more income they need from their nest egg. And again, that's the biggest reason why people are panicking. So what we want to do is reduce this. How in the world can we look into this system to see how we can plan for your retirement income need? Well, I can tell you first off, when we calculate this plan, what we're trying to do is say, okay, you've got $1.4 million today. If we need to make sure that lasts through the rest of your life, what rate of return do you need to average? And I can tell you that's 2.5%, 2.35% in this example. That's not you, that's this example. That means to account for all of this income that they need, this person needs to average 2.35%. What rate of return do you need to average? I have no idea. We can figure it out, but this person's 2.35%. So what we've done is we've invested all of their money and we put it to work. And I've said this for years, and I'll tell you, if you want to retire, you need to put your money to work. So what we've done here is we've invested their money into investments, strategies that produce income, okay? And what you're gonna see here is the same scenario before where we had this red that we had to address. And what you're gonna notice here, all of this purple, that's all the revenue and income their nest egg is now generating because we put the money to work. And since we put that to work, not only did we make all the red go away, but now we have excess. There's more money that's coming into their account on an annual basis, monthly basis, than they need to spend. You want to talk about resting at night, falling asleep with no worries in the world? Plan for your income. If you've got more income coming in your future than you need, you will rest easy. The power that's in income is the power that'll give you the confidence you need to sleep every single night without the worry. The other biggest concern in retirement is health. And I'm not a doctor, I can't help you there. But financially, we can empower you to make decisions, to take control of your future, and give you the ability to sleep at night because your money's working. The money's working when you're asleep. Your money's working when you're awake, and it's always generating what you need, which is income. All right? So let's analyze a couple big things. One of the big things I talked to you about earlier is pension income. So what you're going to notice right here is I've got their Duke pension right here that starts at 65, it's $17,000 a year, okay? So they're bringing in $17,000 a year. What we're gonna notice here is the retirement income need. We're at 117%. We've got more money than we actually need to the sum of 17%. We've not only accounted for the 42% deficit, now we've got a surplus of 17%. It's all good. We can take that pension and feel really good about it. But let's just see for kicks if we took the lump sum. Because if you take the pension, the pro is it's pretty secure. The annuity, the company that's going to pay you some amount of money, in this example, it's due and it's $17,000. But if we don't take that $17,000, okay, now we're gonna forego the annuity, and what we're gonna do is we're gonna take the lump sum, which is roughly about $270,000. So we're gonna put the $270,000 in, take the pension away. The first thing that I'm gonna share with you is now it's dropped from 58% to nearly 50. So we've dropped, what, 9% because that pension income is now gone away. But we have $270,000 more money to actually invest. And what we're going to do here is we're gonna invest that money. So we're gonna come in here and we're going to take that we're gonna invest that. Probably should have done a little bit of work here. So I'm gonna invest that $265,000. And I'm going to start that income. And we're gonna put it into some dividend producing investments, all right? So that would be roughly, all right, so we put that money to work. Get out of here. That money has now been put to work. So we wanna see what was better. Was it better to take the annuity and the pension, or is it better to take the lump sum? So now we've put that $265,000 to work, and look at that. Yes, we do have less of the blue. You know, went from 58% now to 49. Now we have to generate 51% of retirement income. And guess what? When we put that money back to work, remember it was 117% before. Now it's 128%. And all we did was buy dividend investing stocks. No magic to it. Very, very easy stuff. So here we could argue there's a real legitimate reason to take the lump sum over the annuity or the pension. Not suggesting you do that. We have to see how the math works out, but in this example, I'd probably recommend they take the lump sum. Most of my career, I recommended them take the pension or the annuity. Another thing we want to talk about is the concern for long-term care. So what we're going to do here is we're going to put in very easily a long-term care scenario. So I'm going to put in here that unfortunately, Ozzy, you're going to go into long-term care. We're going to have you go into long-term care for about 5 years. And let's just say that annual need for long-term care is about $80,000. Okay, this is long-term care. And now what we're going to see is we're going to see a spike on their income chart. And what you're going to notice here is this big spike. And that's the need for retirement income for specifically long-term care. I really don't have any idea if they're going to need long-term care, but this is the way you can plan for it. When we look at their income plan, remember we had all that extra income? Well, not only do we have the extra income, but I can tell you, because we have that extra income, we don't need to generate $80,000 for long-term care. We only need to generate about $55,000 for long-term care. So if long-term care is a legitimate concern for you, we can very easily, specifically plan for long-term care. Is it traditional long-term care that you need? Do you need an alternative version because of the way your assets are set up? Is there anything else we can do, or can you self-fund it? I can tell you for these people right here, there's probably a strong scenario that we can self-fund, but we can also buy something, invest in something pretty cheaply to accommodate the $50,000 need. say all that to say this. No matter what your concern is, are you worried about running out of money? Are you worried about long-term care? Do you have to make this big decision to take a package if you want to retire early? Do you take your pension? Do you take your lump sum? All of that can be easily and very quickly. I mean, I don't know how long this video is, but I can tell you, we went through a lot very quickly. We'll take our time, slow down, make sure you understand everything, but most importantly, you will understand where you are and if you can afford to take that package and ever have to worry about running out of money. Again, my name's Paul Durso. Our company's Folios, and we'd love to take you through your very own simplicity plan. Thank you.